Assalamu alaikum, my dear student. I am Sadia Hussain, lecturer, Department of Finance and Banking. Today I am going to discuss chapter 4, which is risks and uncertainty. In today's lecture, I am going to discuss some theoretical concept. My dear student, today I am going to discuss chapter 4, which is risks and uncertainty. In our today's lecture, I am going to discuss some theoretical concept. Risks. The possibility of happening anything beyond expectation is called risks. That means the possibility of actual result to be different from the expected result is called risks. Uncertainty. Uncertainty refers to the difficulty of predicting outcomes because of limited or inexact knowledge. That means when the probability of happening something cannot be determined mathematically, then it is called uncertainty. Risk-free return. When the expected return equals to actual return, it is risk-free return. Income from treasury stock and treasury bond of a country is considered as the risk-free income because these sources are issued by government. Certain amount of return can be earned by investing in these sources. This is why it is called risk-free return. Standard deviation. Standard deviation is a method of measuring the risks of both historical return and expected future return. This is a statistical method. It is also the most popular and easy method of calculating risks. Higher value of standard deviation indicates higher risks and the lower value of standard deviation indicates lower risks. It is ideal to accept project whose standard deviation is minimum. Risks are basically four types. From the perspective of investors, there are two types of risks: interest rate risks and liquidity risks. Then, from the perspective of business firms, there are also two types of risks: business risks and financial risks. Let's see what is liquidity risks. Liquidity risk arises from failing to sell the assets quick enough to minimize the loss. Liquidity is the ability of a company to pay the debts without suffering much loss. However, companies always do not get lucky to liquidate their investments whenever they want. From this uncertainty, risks of liquidity arises. This kind of risk is higher for sole proprietorship and partnership firms. Interest rate risks. Interest rate risk occurs from buying bond or the fixed income investment will suffer as a result of a change in interest rates. Generally, business organizations invest in bonds and debentures to earn profit. These investment tools are related with some risks. The reason is the value of the investment moves upward or downward. If the interest rate increases, market value of these investments goes down. On the other hand, if the interest rate decreases, the value also goes up. The possibility of decreasing or increasing the value is known as interest rate risks. Financial risks. Risks arises from loan repayment is called financial risks. Financial risks is a failure of not paying the principal and interest of loan timely. Loan is a liability for a business. Interest expense is compulsory payment of debt financing. Business risks. If company finances only through reserve fund, business risks will arise. Business risks is the probable failure of not paying operating cost of the business. Operating cost includes salary of labor, office rent, raw material purchase, and so on. If reserve fund is fully used in financing, business risks will arise. Implications of risks. The fact that risks has important roles in the decision-making process of business organizations shows the significance of risks. Firstly, risks has impacts on the success of any company, that is, in fulfilling the overall goal of the company. Risks has been defined as the probability of experiencing any unexpected outcome or events. Therefore, if the company anticipates and analyzes different future conditions and take necessary measures in its decision making process, it can be avoid or expected losses. Secondly, earning profit by business organization depends on the demand of its products in the market. Therefore, before starting a business, a firm should analyze the demand of its products and make a realistic estimate of its sales. In other words, it would plan ahead and implement the plan wisely. The actual demand can be higher or lower than the estimated demand. If the actual sales are lower than the expected sales, then the firm cannot earn enough profit. My dear student, that's all for today's class. If you have any kind of questions or queries, you can call me or you can clear your confusion or any kind of queries in our Zoom class. Allah Hafiz.